Greetings, market rebels. Welcome to this week's macro measure. I'm Wayne. My partner Ryan is working on the market outlook, which will be coming out a little later today. It's Monday, December 26th, about 1:30 p.m. on the East Coast. Hope everyone is having a wonderful and safe and healthy holiday season to this point. Let's get going on the advance. We've got to flash our critical slides and then we get into it. This one's probably going to be a little shorter because we're in holiday trade and it's tough to know what you can really bank on, what's real, that kind of thing. So here's our trusty disclaimer. And of course, we've got the trusty intellectual property rights notice for everyone to take a look at. So thank you on that. Now I should be able to switch over to another screen. Just bear with me and then stop share. And then let's pick up a different screen. Let's pick up this screen here. And that should do it. We should be sharing the graphic that we've been utilizing now for a few months to kind of cover the seasonality during midterm years. And as we noted many times, right, the second half of, December, really, it's tough to argue against it the market moving up, the S&P moving up. So that's, I guess, your expectation, but will we get it? We didn't really get it mid-month, right? We didn't get that start of things really yet. So maybe the seasonality playbook, which I think has been fairly good overall, maybe it isn't really playing out as many would expect. We'll have to see. I thought last week was kind of a little bit of a nothing burger, but we'll take a look at those charts soon enough. I just wanted to note a few things to kind of see, let's see where we are, set the table. And that is that we've been checking out the number of stocks that are above certain moving averages. And you can see that this one has quite a bit more to go. The 200 has quite a bit more to go to get down to the low levels we've seen when the market's really gotten rocked. And that's interesting. We'll just to be thorough, we'll take a look at the 50-day. Percent of stocks above the 50 has come off pretty nicely, but could come off a lot more in a real complete risk off scenario. And then the 20-day percentage of stocks above the 20-day average got down there, but maybe not really as low as we've seen. So maybe still a little bit more room there, but that did correct pretty significantly since the start of December even. So that's a quick look on that. Wanted to note this for everyone. Here's a look at the ETF activity last week. And remember, this was a holiday week. So just think about how much they squeezed in during that sort of shortened holiday week in terms of ETF activity. So the previous, or I should say the prior Friday we closed out was IWM and SPY action. You can see we had a lot of TLT, there was LQD, HYG, IWM, and SPY again and again. So my personal take on this, which is why I'm sharing it, is that when I see this, I start preparing for this type of across the board sort of stuff. This is probably not as strong as I've seen it at its strongest, but still for a holiday week, I thought it was pretty interesting just how much happened. And we usually see that right before we're about to either take off, and a lot of these put buys are hedges, or they're hedging potential or initiating aggressive bearish positions. So that tells me that we're probably close to some kind of the start of something significant when I see that kind of stuff happening. So I would be prepared. Now it could be delayed obviously into the new year because I've seen end of year weeks, excuse me, like the one we're about to start. I've seen those both be interesting and complete duds, of course. So it is what it is, but just no way to know that to my knowledge, no way to know in advance, right? You could say, oh, I'm sitting it out. If it'll be boring, it could be great. I'll be there, but I don't know what the tip off would be. Of course, a lot of what we're talking about is sort of absent of news. So who knows what will develop or what the market will take from the over the weekend news and seize upon that to start moving, if at all. But good thing to keep in mind is we're starting out already in fear, right? So we have seen a decent back off, And on this one, this alternative one, we found this is definitely they've got this one in the greed level, so we can't even get agreement there, right? So it's tough right now. We've been looking at the Fed watch to kind of set the table for things. Ryan will probably have more on all this type of stuff in Market Outlook. We've tried to find as many good bits of info we can share every week. That's what we do in there. Ryan does a really nice job of putting that together. But here you go. These are the expectations. But remember, we're pretty far away. We still have, I think, 37 days until the next Fed get together. So just keep that in mind. So the market gets to trade. Now, these, of course, could ship, but the market gets to trade without having the Fed set up, influence it for a while, other than potentially speeches or something out of the blue. And I'm going to come back to this list because I think this is really important. So towards the end, once we get through the quick look, I'm going to come back to that, and then we will take a look at some of these big companies, because that's, I think, where the rubber is going to meet the road. And things look kind of interesting. Let's take a look at the SPY now. This is corrected pretty nicely. It did seem to find support. We thought 390 was important. It lost 390. We thought 380 was the next level. It's been playing around trying to hold 380. So that level definitely seemed to have helped and worked out. It did close the gap we talked about way back when. And so now you have to decide, well, what does this mean? And you can really make the case that things do not look good. You could make that case because you could say, well, you know what? Most of the longer term SMAs are all downsloping. The shorter term SMAs in white, red, and blue, they've all really started to roll over harder. The 10 is about to cross the 50. The 20 is on its way to crossing below the 100. You can 100 SMA, those kind of things. But again, it's tough to say, you know, what this is. And you can see the volume is really nothing special on most of those days in SPY, in really stocks. It's typical holiday-esque trading. But a bull, someone with a bullish mindset, can make this argument. Well, this is kind of reminding me of like more of a cluster low, like we've seen in here, like we maybe saw here, and maybe this supports for a while. The other thing they could say is, well, wait a minute, this low here, which was the worst day of them all, which was Thursday, it's certainly better than that low. So at least we're still hanging in there with a higher low. And really, with the seasonality supposedly helping the market, if there's no bad news, this thing really should work its way back up. You could make that case. And so with the RSI where it is, it got lower and then started to, on Thursday, and then started to improve. So I could see that being the case as well. But I think what we have to look for is that this is kind of balanced right now. And even the cyclical stuff that I like to keep, which I always keep off screen because it's just very messy and hard to explain. But all that stuff that I keep off screen is also kind of at odds with each other. So I don't have really clear, hey, everything's oversold. It's not, even though we saw in the fear and greed battling it out with two different approaches that we saw there, regardless of the validity of them, just kind of a point I'm making, because I think it is a little bit tougher to say what's going on here at the moment, excuse me, because it's been 5 sessions, right, that where they've been able to hold this around this 380 mark. And it would take, you know, clearly, right, we could say, well, breaking below now at this point, below those wicks is the start of something. So 378. And then this, obviously, this wick here would be an issue. That would be a bigger deal, right? But you probably can't wait to trade all the way down if you want to go short all the way down to 374. 378 is probably where you're looking to consider doing that, or maybe even sooner, depending on what type of charting you like to employ. But you could make the case that this is a double top, and that here and here, and that you could fall to here, a weak bounce, hit the 50, reverse from it, and you're doomed, right? So I could go back and forth on this, but when everything's this jumbled, I just look for other things and to see what I can find. And so I don't think the SPYs are easy right now. And despite what, and I think if it wasn't for the end of year tendency, I'd probably be leaning a little more bearish overall because of what I see and hear with downsloping SMAs really struggling to get back above any of them. But again, you have to factor in the holiday-esque trading and lower volume totals, and kind of say that, hey, realistically, versus the week before, let's see what happened there. This was kind of a docile week in a way on a volume basis. It wasn't anything special. I don't want to read too much into that. One way to look at it, not saying it's the way, just one way to look at it. Now, if we take a look at the diamonds, there's a slightly different look. They're above their 50 SMA. They're above their 200 SMA in purple. And so that would be gold and purple respectively on my charts. And so they look a little bit better, but you can see even their shorter term SMAs are rolling over. But they did hold where I think most technicians would say, yeah, it should kind of hold in there. You've got this level, this 325-ish level on the DIA, and you can see that sort of bisects some openings, some closes, the tops of wicks, the bottoms of wicks, call them shadows, whatever you want. But that's the whole thing. You've got that look there, a little bit bigger picture look. And as we've said, you know, the diamonds, I think, look a little bit more, it looks a little more constructive in there. And some of the sectors like the XLI, that's been favored more material. So a lot of things like that that could play out, to help the diamonds. But still, it's not that easy because the half full people are going to say, oh, look, it's holding the 200, got back above the 50 in gold. And then half empty people are going to say, yeah, but look, it ran into resistance, couldn't get through it. And now all those SMAs are rolling over, much like they were here. And you know what that means. So again, I don't think this is an easy call. I think you're really looking at waiting on breakdown or breakout. I mean, I think by the time this would maybe try, the 20 will probably be a little bit lower. The 20 is a little bit lower. You could use the 20 to break out to the upside. And probably realistically, you've got to use the 200. You can't wait forever. So you've got to use the 200 on those to do the breakdown. But then you've got the 100 and 150 waiting for it, which they're nothing to kind of, I think, shrug off in terms of providing at least some support on the first time that the ETF would hit there. So, but that's what I think you're doing in some of these right now, because I don't think it's clear cut. I think when I see my cycles stuff, it's all jumbled up. That tells me it kind of, honestly, it kind of reflects, oops, bad click. It reflects the fact that, we had this kind of like listless market, this holiday-esque market, and things became kind of a little bit more neutral, if you will. There just became a little bit more neutral, where there wasn't enough downside push or oomph. And it looked like things were getting ugly, and they again pulled the rabbit out of the hat in front of a big American holiday weekend, like they often do, and made sure everything stayed intact there on Friday. So very tough to say. We're looking at IWM now, just to be clear. So again, I think this looks worse than the Dow, clearly, versus with the SMA complexion as it is. But again, look at this tail off in interest. Now we've seen worse, and that was probably around the Thanksgiving holiday. But you can see that's really not a lot of interest right now. Interestingly enough. So I'd probably have to say, look, you probably need to look down at this open. This lowest open of last week is probably the closest thing I could come up with, which dovetails with some sort of flat line-ish activity back in here. You can wait for the wick. That's an even longer wait. So it's tough right now in there. And probably you need to wait for this wick here on the 21st to get through there. I think you can push back up. So that's not easy right now. That's just not an easy call. If you look at bigger picture and you give the benefit of the doubt to this longer term trend, then you've got to say, I'm sticking with the downtrend. I'm still a bear overall. I mean, I am, but I'm trying to talk about what happens this week that we're approaching, right? And that's where the rubber meets the road for trading next week. And as far as that goes, I think it's a tough call, at the moment as to what we're treated to this week. It just overall still looking bearish, but could you see a little bit of an attempt to move things back up to come in line with seasonality? Yeah, we know that you could. So again, I'm not strong this way in terms of what I'm where I'm leaning. I'm ready to be, again, neutral, not force a look when you don't need to. There's, again, balance. There's arguments that you could be made on both sides that are so becoming like really emphatic or super pound the table-ish to me is it's not the right time to do that. Although I think some of these bigger stock looks will help us that are coming up in just a minute or two. But QQQ faring probably the worst of most. And this is much closer to that area, that cluster low that we saw early Nov. And that's obviously not very good. The trend is still down. There's still room to fall. RSI readings on some of the big time intraday charts, little below 50. But if you go out to in the dailies at 38-ish, I think, yep, 38-ish if we round it off. So you could say, well, you're getting oversold. You are, but are you really there yet? I don't think it's been smashed enough to say, yeah, it's definitely a buy. So when in doubt, I stick with the longer term, bigger picture trend. But this Friday was a tough one because they were able to hold that up. If that thing kind of closed poorly, I would have thought that we probably would, the seasonality thing would be basically off for the year. They would see more tax loss selling, at least to start the week, because there's enough time for stock trades to settle before the end of the year. Excuse me. And then we probably test this because people just say the hell with it. Tax loss selling, the momentum's down. I'm done. And that's leadership stuff there in the queues with the big names that are in there. But we didn't get that. So I think you have to wait that out and just say, okay, if I'm going to trade breaking below Thursday's low, it's probably close enough that you can work with it. The way the queues can move at times. And if not, probably Thursday's high you could start using for, hey, we get back a little bit. But I don't think there's anything great here on these index ETF charts. So I'm not really going to spend all that much time on them other than what we already have. They're in my book, they're just kind of mixed at the moment. I don't see anything that's really stand out tremendous that we can seize upon with great confidence. When it comes to some of the other big stuff we look at, the dollar kind of disappointed. So dollar, I think, had its chance to do more, but it's working out this kind of little mini triangle type stuff is happening in there. And since I said it, I guess I'll draw that really quickly for us. But you can just, I think you all probably can already see it by now, but something like that. And then maybe, excuse me, allergies must be getting me or something is getting me, but you can see that. So I think we're getting close to something there, but what, right? That's the thing, but what? So I guess if it starts to take out the 20 there in blue, I'd be more inclined to think that there's a little bit more rally potential here and that the dollar starts to tick up a little bit. And then if it takes out, of course, Thursday's low, there's very little there, and it could be rolling back over to make new recent lows. And that's the intermediate trend. So until it proves it doesn't want to do that, I would probably, if I had to say one way or the other, I would stick with the dollar dropping at the moment, right? Just because that's the intermediate term trend. But I think we know that we're looking at breakout or breakdown levels. The TNX, I'm sorry, I wanted to look at the VIX, then the TNX. So the VIX, this tried to come to life with what we saw Thursday, and then it just got smoked on Friday again. So VIX continues to have trouble getting out of its own way. It looks right now, if you look at in this trend, it looks the opposite of it's similar, I should say, to the market, and so that there's overall intermediate trend has been down in this, but it still hasn't gotten all the way down to where we thought it could yet. Got really close here. I don't want to be a stickler on, hey, it has to get to 1852, but I still see this potentially getting even cheaper. And I think that would be good for us as traders because we are going to want to position ourselves for the year with cheap volatility if we can get it. And so we're going to be talking about that, I think, a lot in the near future at Market Rebellion. But yeah, that would be nice. I would welcome that. So that means, right, more than likely means rally, or at least the lack of a major correction for the VIX to drop even further. But the one that is interesting, this is where the monkey wrench comes in, I think, to what we've been saying, is the TNX. So yields, the 10-year yield is working its way back up, and that's looking more constructive. You can see the SMAs, the short-term SMAs, starting to swing up towards, and this trying to work towards that 50 up there. Again, we're looking at a yield. We're not really looking at the price of the security. So just keep that in mind. But you get the idea that the yields are trying to work back up after this major pullback that they had, which was really overdue. I think we were covering that at the time, saying how you just can't be surprised by this. So the lines we worked with actually worked out pretty well, and the overbought conditions were so extreme on so many large time frames that we knew that if it did go into correction mode, it could definitely have a serious correction, serious pullback, and it did. And now maybe it's on its way back up to see if it can either take out the high, put in a lower high. We'll see what happens on that one, but certainly looking better. And this should concern bulls in equities, just because we know there's really been this inverse relationship between the yields heading up and stocks over the past year or so. So keep that in mind. That's the big picture stuff we typically look at. Just going to go through the charts of those big names that we talked about, and then we'll wrap things up here. Let me see if I can get those. They're right here. So let's look at this and try to be objective about this. And I looked at them, of course, already, but here's Apple. And if I look at Apple, I could say, well, look, Apple's down near 35 on the RSI. It's touching my Bollingers. It's overdone. It took out these lows, and that's going to be a fake breakdown, and they're going to just let it come down a little bit and start working it back up, and that's going to be great for the market. Could happen that way, but got real close right to the low of the year. Remember, this is Apple. Got literally within 60 cents of the low of the year on Friday's session. And this is a pretty big deal. So I see this really as an important factor, which is why we're looking at it. And so this thing's close to really breaking down. If they take that low out, I think you're looking at a lot more downside. I mentioned that in Apple and Tesla, that I thought they could really fall a lot more than most people would, I think, believe that they could. I think we mentioned that last week, and I'm still with that. I still think that could happen. And that, of course, would be pretty negative for the market. But if you look at it just in terms of vulnerability, Apple looks vulnerable. There's a little bit of saving grace in that it's almost oversold. Maybe it got oversold, very close, 32 on the RSI on a closing basis on the daily. But if it can't get away from here, I mean, this is just bad. And you can just see that this broadening formation just portends much lower prices if Apple can't hold that low, and then the selling even intensifies from there. So I would say keep that in mind. The next biggest big dog that we'll look at is Microsoft, and this looks better. They did kind of work things out a little better on that Friday, but note, right, that this gap here is still within striking distance for sure, and it could act as an attractive price level if the market sells off, if Microsoft sells off. But it is also below all the SMAs, right? So that means, like, two things to me are those two big dogs are at like a critical juncture, I would say. And if we look at Google, this looks a little bit better, I think, in terms of trying to find a higher low versus here and trying to turn up a little more strongly on Friday. That's the positive spin. The negative spin is all SMAs are down sloping, and it would be rallying right into down sloping SMAs. It's below all of them too. So again, hard to bank too much on that Friday action, but I mean, that's not a chart that I think you're dying to buy at this very second. It might be trying to put in a higher low, but we need to see in my book, we need to see some upside momentum before we get excited about that. because otherwise, right, every little bit of trend info is negative. Amazon, it made a new low on Thursday for the year, a new low, right? So again, next biggest dog out there, and it's barely off the 2022 lows. And you can see there's a lot more room for that to fall if we get into that washout scenario should one develop. Okay, so but again, we're going through this, and I'm just noting that these are stocks that are in jeopardy. They have some financial jeopardy associated with them at the moment. Berkshire a little bit better, clearly, which has been the case. So one little pop, it's above all SMAs, and the best thing we could say there, besides that, is that you're getting flatlining out of the longer terms, and the shorter terms, while sloping downward, it could be above there, and that would all turn around fairly quickly in a market rally. So let's call that a little bit more on the bull side. UNH, this one's kind of flatlining, right? Stuck between short-term and long-term moving averages. Again, you're going to use probably the 20 in light blue and the 200 in purple, tell you what side to trade it on. So if the market's wind is prevailing in one direction, then the stock breaks above or below in that same direction, then that would become interesting. But right now, right, it's betwixt and between J&J, another monster market cap. This one's similar but different. It's above all of them, right? It's kind of a defensive name, and it's got some of the SMAs are still upsloping nicely in there. So overall, right, I would say that's a positive. Now remember, these weights are not quite what they are in some of the other big names that are in tech. XOM, this one looks a little bit better. Notice, right, that looks a little bit better, about to possibly cross the 50 in gold there, or maybe it has barely. And if it holds that and goes, maybe it tries for to take out these highs and move on with another leg higher. Could be the case. So worth keeping an eye on. Did a nice job of supporting there. Never broke down further. So these SMAs are upsloping in the short term there. Visa, this is the ninth largest company, and I'll try to get back to more of a 3-month look. So maybe that would be a little 6-month look will be good enough. It'll be more clear for everyone. But this one, a little bit more dicey, right? You can see the 50 and 200 are right there. So trying to look a little bit better. I guess we'll see what the reports bring for the holiday action from consumers. But that clearly came off big recently, and it's trying to reclaim that. But you've got the short terms rolling over. So that one to me is kind of more neutral on that look. Tesla, this has been one, again, we said last week we were concerned that this could fall further than most people would expect. And I hate to say it, but I still think that's the case, and probably won't change my mind on that one until we're safely away from some of these really dangerous areas. But this support line may need to be revised at this point because of how far we fell. I still think we can fall significantly further. But let's face it, you're outside of your Bollinger Bands, you're below your support line, and you've got an 18 reading on the RSI. So I think, right, this is definitely, to me, given the precipitous fall, a trampoline bounce candidate if they can get the market and the stock going. I mean, this thing could be up pretty quickly, much like you see in a scenario like that, or a scenario like this, where just in a few sessions they move it up dramatically. So if there's one so far that I would that and Apple, but certainly this looks worse. So I think this is your best trampoline bounce candidate that we've come across so far, because again, the harder and faster they fall, usually the better the trampoline effect on the way back up, especially for such an emotionally charged name like Tesla. We'll do JP Morgan and Nvidia, which are battling it out for the last couple on our list of the big dogs. JP Morgan, you have to say overall that looks better than a lot of the things we've seen. Held on at the 50 or above the 50 for quite a few sessions in a row. With one solid session, it could be back above the 20 and all others. So that doesn't look bad. And then Nvidia, Okay. NVIDIA is a tougher one where you're barely above the 50 in gold. You touched the 100 on really Thursday and Friday, and you held so far on the 100 kind of gray white dash line. So to me, this one's pretty straightforward. If you take out the low there on Thursday in a heavy market, then you're coming down to close this gap more than likely, is how I would look at that. If you manage to hold on and get back above the 150, which is right there in that rust color near 156, you get it back above there, and they, in a bull market, they try to push towards the end of the year. I would look towards this 20 as the level that it tries to pop back up to. But that to me is a possibly pretty good trader at the moment because of where it is. If it can break down or break out, it does offer solid movement potential. But I think, as you could see, that overall, the bigger names that are tech do not look as good overall as the other names we looked at that are non-tech. And so that it really explains, right, why the Qs, the technical complexion on a lot of these bigger stocks, that explains why the Qs are struggling relative to the diamonds or the spiders to a lesser extent, certainly versus the diamonds. So, you know, this is where I think doing your work pays off and prepping yourself for, well, if things are working to the upside, you know, what's likely to go? What's likely to go in a modest upside? If it turns out to be a really strong bull push, we know some of the names they might come after that are really beaten down too, and those would be good candidates. But if you want to stay in things that are working in a modestly up market, you stay in these bigger names like the ones we've been charting that are looking better. But it's even mixed that way, and you can see that. So I think it's a tough call. I mean, that's the thing. I don't want to dodge making a call or a lean. That's not what I try to do. I try not to do that too emphatically. I'd rather be open-minded and take what comes our way and do the best we can to adjust and adapt to what's unfolding. But we have tried to make calls towards our leans, right, a little bit more to help people out. And to right now, I just don't think that's easy. When in doubt, you stick with the trend, but even the intermediate versus the long-term trends are mixed. And that makes it hard because short-term trend is matter of a few days, right? But intermediate term can go from several days to maybe, you know, a month and a half, 2 months in my book, that kind of mindset. And those are getting a little bit more mixed too. So it's just a little messy in terms of being really clear cut. And I think you just have to be opportunistic at this point still and see what, if any, news develops that could really create something. But certainly big tech, vulnerable still, really playing with a little bit of fire technically if they let more selling transpire. If they manage to hold that and the seasonality kicks in, some of those names obviously that are pretty heavily beaten down like Tesla, maybe Apple, they could see a nice little reversal. We're other than that, we're just in wait and see mode on breaking key levels and going with it. I just don't see anything super strong to lean on. So I hope something I've shared with you helps you out this week or in the future. And I'll be recording the sector situation video shortly. So we'll see you in the webinars and so on and so forth this week. Thank you.